There's a moment in financial history that changed everything. August 15th, 1971. President Richard Nixon appeared on television and announced that the United States would no longer convert dollars to gold. The gold standard, which had backed the dollar since the Bretton Woods Agreement in 1944, was dead. Overnight, the dollar became pure fiat currency. No gold backing, no asset backing, just government promise and printing presses. That single decision reshaped the entire global financial system. It ended the post-war monetary order. It gave central banks unlimited power to create money. And it triggered a decade of inflation, economic chaos, and currency instability that redefined what money actually meant. But here's what most people don't understand about 1971. The currency reset wasn't a choice. It was inevitable. The United States had spent more than it earned. It had fought expensive wars in Vietnam and Korea. It had funded massive social programs. And foreign governments, led by France, had started demanding gold in exchange for the dollars they held. America was running out of gold. The system was breaking. Nixon didn't reset the currency because it was a good idea. He did it because the alternative was worse. The dollar would have collapsed entirely if he hadn't acted. And right now, in 2025, we're approaching another moment exactly like 1971. Except this time, there's no reset option that saves the dollar. This time, the consequences will be far more severe. The warning signs are identical to what preceded 1971. Massive government spending, unsustainable deficits, foreign creditors losing confidence, and a currency system built on debt that can't be repaid. The only question is timing. Will the reset happen in 2026, or will we limp along for another year or two before the system breaks? History says we're close, very close. This is the story of what happened in 1971, why the current system is collapsing in exactly the same way, and what the coming currency reset will mean for your savings, your income, and the value of every dollar you own. The parallels are exact, the ending is predictable, and the window to prepare is closing. Let's start with how we got to 1971 in the first place. At the end of World War II, the United States held approximately 70% of the world's monetary gold, over 20,000 tons. European nations and Japan were devastated. Their infrastructure was destroyed, their economies were shattered, their currencies were worthless. The United States was the only major power that emerged stronger from the war. And that dominance led to the Bretton Woods Conference in July 1944. At Bretton Woods, 44 allied nations agreed to a new international monetary system. The U.S. dollar would be the world's reserve currency. The dollar would be backed by gold at a fixed rate of $35 per ounce. Other nations would peg their currencies to the dollar. This created stability and trust. If you held dollars, you could exchange them for gold. That convertibility was the foundation of the system. It meant the United States couldn't print unlimited dollars because every dollar was a claim on a specific amount of gold. For the first 15 years, the system worked. The United States ran trade surpluses. More goods flowed into America than flowed out. Gold reserves remained stable. The dollar was trusted globally. American economic dominance was absolute. But empires are expensive, and maintaining dominance requires spending that eventually exceeds revenue. In the 1960s, cracks began to appear. President Lyndon Johnson launched the Great Society, a massive expansion of social programs, Medicare, Medicaid, federal education spending, housing programs. Simultaneously, the Vietnam War escalated. By 1968, over 500,000 American troops were deployed in Vietnam. The war cost roughly $168 billion over its duration, equivalent to over $1 trillion today. Defense spending soared, social spending soared, and tax revenue couldn't keep up. The federal deficit exploded. In 1960, the deficit was $300 million. By 1968, it was $25 billion. The government was spending far more than it collected in taxes, and to cover the gap, they had to borrow. But borrowing requires lenders willing to accept your currency, and foreign governments holding dollars started to notice something troubling. There were more dollars in circulation than there was gold in Fort Knox to back them.
This is where the math becomes unavoidable. In 1950, the United States held about 20,000 tons of gold. By 1960, foreign governments held $18 billion, while the U.S. gold reserve was worth about $18 billion at $35 per ounce. The system was balanced. But by 1970, foreign governments held over $50 billion in dollars, while U.S. gold reserves had fallen to 11,000 tons, worth only $12 billion. There were 4 times more dollar claims on gold than there was gold to redeem them. France was the first to notice. President Charles de Gaulle understood monetary systems better than most leaders. In 1965, he publicly questioned whether the dollar should remain the world's reserve currency when America was printing more dollars than it had gold to back. And then he acted. France began converting dollars to gold. French ships literally sailed to New York, loaded up American gold, and transported it back to Paris. Between 1965 and 1968, France converted $1.5 billion to gold, draining 300 tons from U.S. reserves. Other nations followed. Germany, Switzerland, and Japan began demanding gold instead of holding dollars. The gold was flowing out of Fort Knox at an alarming rate. By 1971, U.S. gold reserves had fallen to 8,100 tons. The dollar was fundamentally overvalued. There were too many dollars backed by too little gold, and everyone knew it. Currency speculators began betting against the dollar. International banks started hoarding gold, and foreign governments accelerated their conversions. President Nixon faced an impossible choice. He could continue honoring the gold standard, which meant watching Fort Knox drain until there was nothing left, or he could close the gold window and break the promise that had backed the dollar since 1944. On August 15, 1971, he chose the latter. The announcement was sudden and unilateral. Nixon didn't consult with allies or give warning. He simply appeared on television and declared that the United States would temporarily suspend convertibility of dollars to gold. He said it was temporary. It's been 54 years. The gold window never reopened. What followed was chaos. Within days, currency markets went haywire. The dollar lost 10% of its value against other major currencies within weeks. Foreign governments that had trusted the dollar felt betrayed. The Bretton Woods system, which had provided monetary stability for 27 years, collapsed. By 1973, most major currencies were floating freely, no longer pegged to the dollar or gold. This was the birth of the modern fiat currency system. Money backed by nothing but government decree and central bank printing presses. The consequences in the 1970s were severe. Inflation surged. The Consumer Price Index rose from 4% in 1971 to over 12% by 1974. Oil prices quadrupled during the 1973 oil crisis, partly because oil-producing nations no longer trusted a dollar that wasn't backed by gold. Unemployment rose. Economic growth stagnated. The term stagflation was invented to describe the nightmare combination of inflation and recession happening simultaneously. For an entire decade, the American middle class watched their purchasing power erode. But here's what made 1971 different from a total collapse. The United States still had the world's largest economy. It still had the strongest military. It still controlled global trade routes and financial institutions. And critically, oil was still priced in dollars. The petrodollar system, established through agreements with Saudi Arabia and other oil producers, created artificial demand for dollars. Countries needed dollars to buy oil. This meant that even without gold backing, the dollar retained value because it was required for the global energy trade. The dollar survived the 1971 reset because America's economic dominance was so overwhelming that the world had no alternative. Europe was still rebuilding. Japan was an export-driven economy dependent on American markets. The Soviet Union was isolated. China was impoverished and irrelevant. There was no rival currency that could replace the dollar. So despite breaking the gold promise, the dollar remained the reserve currency by default. Now, fast forward 54 years to 2025. The parallels to 1971 are exact, but the circumstances are far more dangerous. Let's go through them one by one. First, unsustainable deficit spending. In 1971, the federal deficit was $23 billion, about 2% of GDP. That deficit, small as it seems now, was enough to trigger the currency crisis. Today, the federal deficit is over $2 trillion annually, roughly 7% of GDP. The government spends $6.8 trillion while collecting only $4.9 trillion in revenue. That gap has to be filled with borrowing, which means issuing more treasury bonds and creating more dollars.
But unlike 1971, today's deficits aren't temporary war spending, they're structural. Social Security, Medicare, Medicaid, and interest on the debt are mandatory spending programs that grow automatically each year. Interest payments alone exceed $1 trillion annually. Even if politicians wanted to balance the budget, they'd have to cut so deeply that it would trigger a depression. The spending is locked in, the deficits are permanent. Second, foreign creditors losing confidence. In 1971, France led the charge demanding gold. Today, China, Russia, and other nations are quietly divesting from dollars. China's holdings of U.S. Treasury bonds peaked at $1.3 trillion in 2013. By 2025, they've fallen below $800 billion. China isn't buying new U.S. debt. They're letting old bonds mature without reinvesting. Russia has dumped almost all of its treasury holdings, reducing them from $150 billion to under $10 billion. They've replaced dollars with gold, increasing their gold reserves from 600 tons in 2008 to over 2,300 tons today. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with new members, are actively building alternative payment systems. They're trading in local currencies, bypassing the dollar. They're creating development banks that compete with the IMF and World Bank. They're preparing for a world where the dollar is no longer dominant. This is exactly what France did in the 1960s, except now it's not one country. It's a coalition representing half the world's population and a third of global GDP. Third, money printing on a scale that makes 1971 look restrained. In 1971, the money supply grew too fast for the gold reserves to back it, but the printing was limited compared to today. Since 2008, the Federal Reserve has created over $8 trillion through quantitative easing and other programs. During the pandemic in 2020 and 2021, they created $6 trillion in just 2 years. That's more money created in 24 months than in the previous century combined. Every dollar created dilutes the value of existing dollars. It's not complicated. If there are $10 trillion in circulation and you create $6 trillion more, the original dollars are now worth 40% less in terms of their share of total money supply. This is why prices have exploded. The official inflation rate hit 9% in 2022. But real inflation, the prices ordinary people pay for food, rent, and energy, has been much higher. The dollar has lost purchasing power faster than any period since the 1970s. Fourth, the reserve currency status is eroding. In 2000, over 70% of global foreign exchange reserves were held in dollars. Today, it's 58% and falling. Central banks worldwide are diversifying. They're buying gold at the fastest pace since 1967. They're increasing holdings of euros, yen, and yuan. They're reducing dollar dependence because they see what's coming. A currency that loses 2% of its value annually through inflation while being created in unlimited quantities is not a safe store of value. But here's the critical difference between 1971 and 2025. In 1971, America could reset the system because there was no alternative to the dollar. Today, alternatives are emerging. China has been preparing for this moment for 20 years. They've built the largest economy by some measures. They've created the Belt and Road Initiative, investing trillions in infrastructure across Asia, Africa, and Europe. They've developed their own payment systems that bypass Western banks. And most importantly, they've accumulated massive gold reserves while letting their dollar holdings decline. The yuan is being positioned as an alternative reserve currency. It's not there yet. China's capital controls and lack of financial transparency limit the yuan's appeal, but they're making progress. Oil sales between China and Saudi Arabia are increasingly settled in yuan, not dollars. Trade between China and Russia is conducted in local currencies. Other nations are watching and preparing to diversify away from dollar dependence. The difference is that in 1971, the dollar reset happened from a position of strength. America was still economically dominant. Today, a dollar reset would happen from weakness. The U.S.
economy is heavily indebted. Manufacturing has hollowed out. Trade deficits are chronic, and the government has lost all fiscal discipline. When the reset comes, it won't be controlled. It will be chaotic. So what would a 2026 currency reset actually look like? There are three possible scenarios, and none of them are good. First, controlled devaluation. The Federal Reserve and Treasury could coordinate with other central banks to deliberately devalue the dollar by 30 to 50%. This would reduce the real value of U.S. debt, making it easier to repay. It would boost exports by making American goods cheaper globally. And it would reduce the burden of government obligations like Social Security and Medicare in real terms. But it would also destroy savings. Your bank account would lose half its purchasing power. Your salary would buy far less. Imported goods would become unaffordable. Inflation would surge. This controlled devaluation is what happened in 1971, except that time the dollar fell about 10%. Today, with debt at $36 trillion and deficits at $2 trillion annually, a 30 to 50% devaluation would be necessary just to bring debt ratios back to manageable levels. The political decision would be framed as necessary to save the economy. But what it really does is transfer wealth from savers to debtors, from creditors to borrowers, and from the middle class to the government. Second scenario, monetary collapse. If foreign creditors lose confidence suddenly and simultaneously, there could be a rapid flight from dollars. Central banks could dump treasury bonds. International trade could shift away from dollars almost overnight. The currency could collapse not gradually, but catastrophically. This would look like hyperinflation, prices doubling every few months, savings becoming worthless, the entire monetary system breaking down. This is what happened in Weimar Germany in the 1920s, in Zimbabwe in the 2000s, and in Venezuela in the 2010s. It doesn't happen to reserve currencies often, but when it does, the damage is total. In this scenario, the government would likely respond by issuing a new currency, a digital dollar perhaps, or a dollar backed by a basket of commodities. The old dollars would be converted to new dollars at a fixed rate. Let's say 10 old dollars for one new dollar. This is a currency reset through hyperinflation and redenomination. It wipes out debt, but it also wipes out savings, pensions, and anything denominated in the old currency. Third scenario, replacement.
The dollar loses reserve currency status entirely. The world shifts to a new system. Maybe the yuan becomes dominant. Maybe a basket of currencies replaces the single reserve currency model. Maybe a new Bretton Woods-style agreement creates a global currency backed by gold or a commodity basket. This is the most orderly scenario, but it still means the end of American financial dominance. It means higher interest rates because the U.S. government can't borrow as cheaply. It means lower standards of living because imports become expensive. It means the end of the exorbitant privilege that has allowed America to run trade deficits and print money without immediate consequences. The timing of which scenario unfolds depends on how quickly foreign creditors lose confidence and how aggressively the Federal Reserve continues printing money. But all three scenarios share one thing in common. The dollar's value will decline dramatically, purchasing power will be destroyed, and wealth will be transferred from those holding dollars to those holding real assets. The signs that we're near the breaking point are everywhere. Bond yields are rising even as the Fed tries to keep them low. This means investors are demanding higher returns to hold dollars, a sign of declining confidence. The yield curve has inverted and then normalized, which has predicted every recession for 70 years. Foreign central banks are net sellers of U.S. debt for the first time since the 1970s. And the Federal Reserve's balance sheet is still bloated, with over $7 trillion in assets, leaving little room for more quantitative easing without destroying the currency entirely. In 1971, the reset happened suddenly. Nixon announced it on a Sunday night when markets were closed, giving no warning. The next time will likely be the same. A weekend announcement, a surprise policy shift, a new currency regime implemented before anyone can react. You won't get advance notice. You won't have time to reposition your wealth. By the time you hear about it, the damage will be done.
So what can you do? The same things that protected wealth through every previous currency crisis. First, own real assets. Gold has been the ultimate store of value for 5,000 years because it can't be printed. In 1971, gold was $35 per ounce. Today, it's over $2,600. That's not gold becoming more valuable. That's the dollar becoming less valuable. Silver, real estate, productive land, and commodities are all real assets that maintain value when currencies collapse. Second, reduce exposure to dollar-denominated debt instruments. Long-term bonds will be destroyed in a currency reset. If you own a bond paying 3% and inflation surges to 10%, you're losing 7% per year in purchasing power. Bonds are essentially loans you're making to the government. When the government devalues the currency, they're defaulting on you in real terms, while technically paying you back in nominal terms. Third, diversify internationally. Don't keep all your wealth in dollar-denominated accounts in U.S. banks. Consider foreign currencies, foreign real estate, and foreign investments. If the dollar collapses, having wealth in other currencies and jurisdictions provides protection. Switzerland, Singapore, and other stable countries with strong property rights offer options. Fourth, understand that your salary and wages are denominated in dollars. If the dollar loses half its value, your paycheck buys half as much, even if the number on your check doesn't change. Negotiate for inflation adjustments. Build skills that remain valuable in any economy. And be prepared for a period where standard of living declines sharply for most Americans. The coming currency reset is not a prediction. It's a mathematical inevitability. The United States has $36 trillion in debt, $2 trillion annual deficits, and a central bank that has printed $8 trillion in 15 years. The dollar has lost reserve currency share from 70% to 58%. Foreign creditors are divesting. Inflation is eroding purchasing power faster than any time since the 1970s, and the government has no plan to fix any of this because the spending is locked in and the political will doesn't exist. In 1971, the currency reset was survivable because America was still economically dominant. In 2026 or shortly after, the reset will be far more destructive because American dominance has eroded while debt has exploded. The dollar will lose value. Savings will be destroyed. The standard of living will decline, and the global financial system will reorganize around new currencies and new power centers. The pattern from 1971 is clear: excessive spending, unsustainable deficits, foreign creditors losing confidence, and a currency backed by nothing but promises. It ended in a reset that changed everything. Every indicator today is worse than 1971. Every warning sign is flashing red, and the window to prepare is closing. History doesn't repeat, but it rhymes, and right now we're hearing the exact same rhythm that played in 1971, building toward the same crescendo. Except this time, the crash will be louder, the consequences more severe, and the recovery far longer. The currency reset is coming. The only question is whether you'll be ready when it does.